Welcome to another episode of the Einstein Retirement Daily, where we look at news and topics and information that could affect today's retiree. Coming up in today's episode, we're going to look at some what I'll call nonsense in the news, and it's all about this issue of taxes and a lot of politics around taxes right now, a lot of energy around taxes, and so we want to make sure that we spend some time looking at that and talking about that and giving you some reasonable information to start thinking about. Okay, as always, if you hear something in today's podcast that causes you to want to take some action or make changes or do something in your specific situation, please be advised that you must confer. Actually, not must, but we very much insist that you confer with the appropriate tax, legal, or investment professional who knows your specific situation prior to making any changes. Okay, article from Yahoo Finance. I apologize. I should have actually already linked it, but for some reason I didn't. I'll link it in the description of this video. But got this article across my table through an Advisor Wealth magazine that I get notifications through. But the original article actually came from Yahoo News. And so Yahoo News has an article entitled, from Michael Rainey, entitled, Ultra Wealthy Pay 8.2% Tax Rate, White House Report. So right out of the gate, we know this is going to be politically loaded. And as we dig in, we see very quickly that it is. The highlight here with this article is that hypothetically, rich people aren't paying their fair share. Okay, so we have a lot of people's opinions about that. Whatever your feeling is, it doesn't matter to me. You can feel however you'd like about it. But let me just explain exactly why this particular report was generated. This report was generated to hypothetically prove that the rich are not paying taxes on their income. However, I don't know why, but at the very end of the article, right down near the bottom, you can eventually find where it says, no, that's not exactly 8.2% of their income. We're not going to exactly tell you what that is. What we are going to tell you is that it's 8%, 8.2% of all their income, plus the appreciation of their investments and assets. So let me just explain something that's going on here. Essentially, what they're acknowledging is that the tax, the hypothetical tax that they're saying is unfair, that these rich families, whoever they are not paying. This unfairness is coming because they are holding an asset that has appreciated in value, and there's no tax for that appreciation in value. Let me put this another way. According to this idea, if we started taxing the appreciation on our assets, anything that you buy and someone in the government says in the future, specifically probably the IRS says in the future, that asset is worth more today than it was when you bought it, you have a tax exposure on that. So you buy real estate. You haven't sold your real estate. You don't have any income from your real estate. You don't have any cash flow from your real estate. But the real estate that you bought 10 years ago is now worth more today. That's a tax liability, according to how they're trying to factor in what taxes would be. So this is not a tax on the wealthy, let's be honest, because the truth is, the wealthiest families, whatever tax they think they're going to impose on that capital gain, the wealthy can probably afford to pay it. Now, is it going to have an impact? Yes. And we'll talk about that in a second. But can they afford to pay it? Probably. Who can't really afford to pay that kind of a tax? A tax on appreciation that is unrealized, meaning you didn't actually sell the asset, so you didn't get any cash flow, but you need to be taxed on it. You. Okay, well, I assume, maybe somebody from the 400 wealthiest families watching this, maybe, but generally, the average American, average everyday working people are the people who can't afford that kind of change to the tax code. But this is the kind of stuff that I don't know. I don't necessarily want to use the word brainwashing, but there's a lot of this kind of news that is very misleading and is not being described in a way that is easy to understand. It just looks like, oh, there the wealthy go, getting away with no taxes. I work with a lot of wealthy clients. I got to tell you, most of them pay a heck of a lot in taxes. And so I don't think that that is an accurate description of reality, the idea that they don't pay a lot in taxes. And that's A. And then B, we're talking about something that isn't realized. Okay, so let's say I purchase a vehicle, and I purchased a vehicle just before the supply issues. I could turn around and sell that vehicle for more than what I bought it for. What the IRS is saying is you got to pay tax on that whether you sell it or not. So I buy a vehicle because of a supply issue in the pandemic. My vehicle's now worth more than when I bought it, which is totally unheard of. Vehicles lose value all the time instantaneously as soon as you drive them off the lot. We all know this, except maybe not in this situation. So now I owe a tax because there's a gain there. Okay, that's the kind of tax that's being talked about. So we need to be very wary of this. I do not think that this is this is a very irresponsible article. If anything, it should be highlighting that this is really bad for average everyday Americans if they keep going down this path. And B, the idea that the White House, whatever that means, some special commission. I'm sure they assign some economists to some special commission to figure this out. But what they're doing is very irresponsible because it is going to hurt average everyday Americans far more than those that they're hypothetically trying to hurt or take money back from or whatever their reasoning or justification is. The unintended consequences on this are obvious, very obvious. Now, the unintended consequence that's not quite as obvious, but really would affect anyone and everyone, is the unintended consequence of reducing the amount of dollars being willing to be invested. If you start taxing people for investing money into a company and you tax the relative value increase of their stock positions, let's say, or their ownership in a company, okay? I mean, just think about all the business owners. If they do a good job and grow their business, they might not necessarily receive a lot of extra income, but if they were to sell their business, they could sell it for much more than what they originally either purchased it for or invested into the company. You're telling me that they're going to tax that? Okay, it's average everyday people and their willingness to invest into the economy that's going to be hurt the most by this. Now, maybe that's what they want. Maybe they want people to stop making investments and investing into the economy. Maybe they want the economy to be more driven by government incentives or something like that. I mean, that's a possibility. Maybe that's stepping a little bit too much in the realm of conspiracy theory or something like that. But maybe that's what they're aiming for. I don't know. But the reality is if you disincentivize people from investing into the economy, you better believe that's going to have a big time impact. And in the short run, it'll have an impact because people are going to have to sell. They're going to have to sell some of their shares. They're going to have to reduce their net worth to pay this tax that would be imposed on them. So I don't know if this is this particular news article is going to lead or the actual activity, but that the news article is highlighting is going to lead to any action. But this is just another discussion around taxes, and the consequences are not obvious at all. And we have to be very careful because increasing taxes is not an obvious solution, although it feels like it if you don't really think about the downstream ramifications of increasing taxes. Increasing or adding a tax, because this would be an adding of a tax. This is not, there's no tax dodging going on here. This is literally adding a tax that doesn't currently exist. That is a big part of what causes dollars to go into investments and provide the energy for the economy. If you have a 401k plan with stocks in it, or S&P 500 funds, or any kind of stock funds or mutual funds or ETFs, if you have any of that in your investment accounts, the reality is that this type of a tax is going to hurt you. Okay? Supply and demand. Fewer dollars competing for the same goods and services, or stocks in this case. Fewer dollars because of a tax imposition is going to reduce the value. Okay, it's not rocket science. It's very easy to understand. If you tax something, you reduce it. Okay, it doesn't matter if the tax is only on the wealthiest, because if the tax is only on the wealthiest, they're the ones with the majority of the dollars competing for those types of investments, and that's going to hurt everyday average people. So don't get sucked in by this nonsense in the news around taxes. I'm keeping very close tabs on what tax is most likely to actually show up. I would say that still, as of yet, it's very uncertain. It's very unclear, but some type of capital gains tax is very likely to come into play. I really hope that this whole, taxing unrealized gains, I mean, that's just crazy. It's just absolutely crazy. I almost can't believe that this commission was actually done with any level of seriousness. I mean, I'd understand if it was a joke, but I assume these are serious people who are doing this, and it's nonsense. It's absolute nonsense. So I do hope that that the smart people in the room, I assume there's some smart people over there, say we can't do this. This is crazy. But obviously we'll keep tabs on it, and I'll keep posted. All right, that's all for today. Thank you. Look forward to seeing you next time.